Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, and we're diving into strategic tax planning for high-income earners and entrepreneurs. If April keeps surprising you, the cure isn't a sharper pencil. It's a year-round plan. Preparation files the return. Planning engineers the numbers that go on it. Today we'll hit entity selection, S-Corp pay, the 1999A deduction, retirement stacking, health and charitable moves, real estate tactics, SALT workarounds, accounting methods, capital gains, credits, and more. Plus pitfalls and case studies. Blueprint in hand, you'll keep more, smooth cash flow, and compound wealth. Planning beats preparation because the biggest savings happen before December 31st. Run a proactive calendar, Q1 kickoff to set goals and entity comp assumptions, mid-year checkup to update income, safe harbors and retirement funding, year-end sprint to harvest gains, losses, time purchases, and finalize bonuses or dividends. Scenario modeling, wages versus distributions, Roth versus pre-tax, buy versus lease, turns ambiguity into math. Coordinate your CPA, attorney, and advisor so elections, agreements, and funding align. When the team syncs, tax becomes an always-on profit lever. Entity choice drives payroll taxes, fringe benefits, the 3.8% net investment income tax, and exit options. An LLC taxed as a sole prop is simple, but exposes all profit to self-employment tax. Electing S-Corp status can trim payroll taxes by splitting profit between reasonable W-2 wages and distributions not subject to FICA, Medicare. C-Corp may shine for richer fringe benefits, QSBS potential, or retained earnings, mine dividend double tax. Think forward, asset versus stock sale, Section 1202 goals, and loss utilization. Build for flexibility and revisit as profits and plans evolve. S-Corp owners must nail compensation, set reasonable W-2 wages based on role, market comps, and time invested. Document it. Use an accountable plan to reimburse home office, mobile, internet, and travel so the company deducts them and you avoid income. Handle owner health insurance correctly. The S-Corp pays or reimburses premiums, includes them on your W-2, and you take the self-employed health deduction. Align wages with retirement plan limits and track basis, contributions, loans, and retained profit, so distributions stay tax-free and losses remain deductible. Section 199A can cut up to 20% from eligible pass-through profit, but thresholds matter. For high earners, wages and UBIA of qualified property are gating factors. Plan owner W-2 levels and consider asset placement or financing that increases UBIA. If you're in an SSTB, mind phase-outs, retirement deferrals, and charitable bunching can pull taxable income under limits. Aggregation can combine businesses to satisfy wage UBIA tests. Document common ownership and operational links. Keep separate books where SSTB lines matter. Above all, model early. Filing season fixes are scarce. Retirement plans legally shift large dollars from taxable to tax-deferred. A solo 401k combines salary deferrals with employer profit sharing. With the right comp, you can hit the annual maximum fast. Add a cash balance or defined benefit plan to push 6 figures more. Best for stable, high-margin firms ready to fund for several years. Pair pre-tax now with future Roth conversions in lower income years for tax arbitrage. Partners and S-Corp owners should calibrate wages or guaranteed payments to maximize contributions without overpaying payroll taxes. Health strategies punch above their weight. A health savings account is triple tax advantaged, deductible in, tax-free growth, tax-free qualified withdrawals. Treat it like a stealth IRA and invest. Bunch medical deductions in years you exceed the AGI floor, pairing with charitable bunching. Small employers should compare QCHRA and ICHRA to reimburse premiums pre-tax, document plan terms, and substantiation. S-Corp owners must route premiums correctly, paid or reimbursed by the company, included on the W-2, then deducted above the line. Documentation turns intent into deductions. Charitable giving can amplify impact and deductions. Bunch several years of gifts into 1 year via a donor-advised fund to restore itemizing while granting over time. Donate appreciated securities instead of cash to avoid capital gains, and deduct fair market value within AGI limits. then repurchase with cash to reset basis. For those 71-2+, qualified charitable distributions from IRAs send funds directly to charity, satisfy RMDs, and keep income off your return, helpful for QBI, Medicare surcharges, and AGI-based phase-outs. Real estate offers timing tools. Cost segregation breaks property into shorter life components, accelerating depreciation. Bonus depreciation is phasing down. Plan purchases with the schedule. It's slated to be 20% in 2026 unless Congress acts. Section 179 can be better for certain improvements in equipment, especially when you need to target deductions to active business income. If your business occupies a building you own, compare rent to self versus owning in the OpCo to shape income types and ring-fence liability. Always pair depreciation with exit planning. Short-term rentals and real estate professional status can unlock losses against high W-2 or business income, only with material participation. For STRs averaging 7 days or less, the activity isn't a rental under passive rules. Meet a participation test. 500 hours, substantially all, or 100 hours and more than anyone, and losses can be non-passive. For long-term rentals, you need RE professional status and participation in each activity, or use a grouping election. Keep contemporaneous logs, third-party records, and calendars. They win audits. 2 sleeper tactics: the Augusta Rule and SALT workarounds. Section 288G allows renting your home to your business up to 14 days annually. The business deducts rent and you receive it tax-free, only with market rates, a bona fide purpose, and documentation. For SALT caps, many states, including Missouri, offer pass-through entity tax elections. The business pays state tax, deducts it federally, and owners get a state credit, bypassing the individual SALT cap. Evaluate cash flow, owner residences, entity type, and election deadlines. Accounting methods are levers that pay for years. Many small businesses qualify for the cash method, easing inventory and capitalization rules and improving cash flow when receivables surge. Time, income, and expenses. Accelerate deductions via prepaid expense rules, de minimis safe harbor, and paying bonuses before year-end. Defer income with billing timing or properly treated deposits. Review, unicap relief, and materials and supplies expensing. Method changes often need Form 3115. Done right, the Section 481A adjustment can produce a one-time deduction and better ongoing treatment. Capital gains deserve their own plan. Use tax loss harvesting to offset gains, but avoid the wash sale rule by swapping into similar, not identical exposures. Place tax-efficient assets in taxable accounts and ordinary income generators in tax-advantaged accounts. Classic asset location. Manage brackets, realize gains up to the 0% or 15% thresholds in low-income years, and avoid stacking gains on top of spikes like Roth conversions. For founders, QSBS under Section 1202 can exclude up to the greater of $10 million or 10x basis after a 5-year hold. Entity structure, gross assets, and active business tests matter, so plan early. Equity grants, an 83B election on restricted stock starts the capital gains clock and traps income at a low value, but it's a use it or lose it 30-day deadline. Finally, the 3.8% NIT hits passive income. Reduce exposure by increasing material participation, using S-Corp distributions, and considering grouping elections. Harvest charitable gains by donating appreciated shares, then rebalance with cash to refresh basis without tax this year. Credits often beat deductions dollar for dollar. The R&D credit isn't just for tech. Manufacturers, architects, engineers, and even custom software and non-tech firms may qualify. Capture time, supply, and contractor costs, and coordinate with Section 174 capitalization rules. Watch for energy-efficient commercial building deductions and EV credits where applicable. Vehicles. Weigh standard mileage versus actual expenses. Heavy SUVs over 6,000 pounds can unlock accelerated write-offs, but business use must be documented with a contemporaneous log. Home office is legitimate when exclusive and regular use is met. Simplified square foot or actual expense methods both work with records. fringe benefits, education assistance, de minimis perks, accountable plans, stretch dollars tax efficiently, estimated taxes matter, use the safe harbors to avoid penalties, generally 100% of prior year tax or 110% if your AGI exceeded the high earner threshold, paid quarterly. Automate transfers, set calendar reminders, and revisit estimates mid-year as income shifts. High volatility earners can use the annualized method to match income patterns, and W-2 owners can boost year-end withholding if needed. Exits magnify taxes, so plan early. Installment sales smooth recognition and can keep you in lower brackets. Earnouts demand careful agreement language. For real estate, 1031 exchanges defer gains. For C-Corp stock, QSBS planning might beat a 338H10 style sale. After a big sale, consider 1045 rollovers for QSBS reinvestment within 60 days. Common pitfalls: unreasonable S-Corp comp, missed elections, basis tracking errors, hobby loss issues, excess business loss limits, and sloppy documentation. Case studies: restructuring a sole prop into an S-Corp and cash balance plan saved a client 6 figures over 3 years. DAF bunching plus appreciated stock shaved another mid-5 figures. The professional edge is cadence, kickoff, mid-year, year-end, and rigorous modeling with your CPA, attorney, and advisor all year long. Want to see more? Visit us at taxsavingsguru.com and sign up to be a VIP. That's a wrap on unlocking wealth through proactive tax planning. We covered entities, S-Corp pay, QBI, retirement stacking, health, charity, real estate, SALT, methods, gains, credits, exits, and pitfalls. Implement the calendar, model scenarios, document everything, and keep your team coordinated and aligned.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.